Hey everyone, it's Rayce Robinson, your favorite Florida mortgage broker, answering a question I get asked all the time, which is how do I drop my mortgage insurance? A lot of people have PMI because they either didn't put 20% down or they did an FHA loan and now they want to drop it. And so the answer is it's kind of complicated because it depends on the loan that you did, the loan scenario, the program, whether it's a primary investment property. So I'm going to go over all the ways that you can drop the PMI so that, whatever your situation is, you'll know exactly what to do. Also, if you find this video useful, do me a favor, like it and subscribe to my channel. Okay, so most people that have an FHA loan, I'm going to speak generally on FHA because it can get a little tricky, are going to have, for the most part, PMI for the life of the loan. So I'm not going to spend a lot of time on FHA, but if you have an FHA loan, for the most part, you are going to have to refinance that to a conventional loan and have at least 20% equity when you do the refinance to drop the mortgage insurance totally. Now, it still may make sense to do it if you don't drop the PMI totally, just to get to a conventional loan, because at some point then it will drop off without having to refinance again, where with an FHA loan, it will not. So FHA, for the most part, you're going to refinance to drop the PMI. Now, a lot of other people did a conventional loan. Maybe they put 3% down, 5% down, 10 or 15% down and have the PMI. For the average person, when you put 5% down, it takes about 104 payments at about a 4% rate, let's call it, to drop the PMI on its own. Because the PMI will drop on its own once you pay the loan down to 78%. It's an automatic drop off in every lender system because of Fannie Mae and Freddie Mac through the Homeowners Protection Act that your PMI will drop and there's nothing you need to do. Now, that's probably not you because most people want to drop the PMI because maybe their property values went up or they made extra payments and they paid the loan down faster. So if you've paid the loan down faster by making extra payments, and I'm going to cover recasting the mortgage at the end of this video for those that might be interested, which means you can basically lower your payment without refinancing. But for most people, when you're making extra payments and you get that loan down to 80% from the original value, where we're keeping the value the same and you've paid the loan down 80%, but you just may have done it quicker by making extra payments. Once you get that to 80%, you can get the PMI company or the lender to drop that mortgage insurance. So those are the two simplest ways: is drop it at 78% automatically, or pay extra and then contact the lender when you get it to 80%, and it's basically 80% of what you paid for the house. Now, where it gets a little tricky, and again, these are on primary residences. I'm going to divide primary residences and second homes are different than investment property or multi-unit property. So again, this is single-family homes, condos, townhomes. If it's a duplex or triplex or an investment property, it's going to be treated differently. Now, for most people, when they're trying to drop the PMI, what they're looking at is the property values went up at the same time they've been paying the mortgage down, and now you want to drop the PMI. I basically did the same thing after the first year I was in our house because we put a pool in. So this is where this gets a little tricky. So if you want to drop the PMI fairly quickly after you originate your loan, say in the first 1 to 2 years, you're going to have to prove to the lender what improvements that you did, and then you basically will get an appraisal. In my case, I had to give them the plans that we did for the pool and everything else, and with the what they call substantial improvements, if you've increased the value of your house, not just the appreciation, you can drop the PMI. Where it gets a little tricky is on a loan backed by Fannie Mae has to go to 75% for them to drop it, where on Freddie Mac it's 80%. And you probably have no idea. There's ways you can look it up online, and they're both conventional loans. But for most times, if you're trying to drop the PMI, their lender's going to want to see what the substantial difference you have made to the home. Now, after 5 years, regardless of what improvements you've made to the home, you can drop the PMI at 80%. So really kind of in that 2 to 5 year mark, lenders are typically going to make you show what differences that you've made in the home. Now again, if you're not using the appraised value and just the value that you paid for it, then all you have to do is get the, have paid the loan down to 80%. So that's where it can get tricky if you're trying to drop the PMI and you haven't made those substantial improvements to the property, then you're going to need to, for most people, get it down to under 75% just off the appreciated, the appreciated value and what you've paid it down to. So that is how it works for primary residences and second homes that are 1-unit properties. Now for investment property and multi-unit property, there is no automatic drop-off. So with them, it's pretty much simple. You need to get the loan down to 70% with Fannie Mae, 65% with Freddie Mac to get the lender to drop the PMI, and you can do that with improvements, with using appreciation, and so you just have to get the value down a lot further. And it is also worth noting that on these, on the ones where you're using the appreciated value, the lender can have some overlays and more hoops that they make you jump through. I know when I dropped it with our pool, we had to send in the pool plans, and they definitely don't make it easy. Remember, the lender wants to keep the PMI. It doesn't help you, but it definitely helps them in case you go into default. So again, with investment property, you're really going to need to get that loan under 70 to 65%, both with what improvements you've made and paying the loan down. Of course, if you just pay the loan down to 70%, that would also get you to drop it. And again, 65% with Freddie Mac. Now, recasting loan is something a lot of people don't know about. I could almost do a separate video on it, but in a quick nutshell, if you're going to pay more down, there's a few other guidelines, but in general, if you're going to pay more than 10% of the current balance of the loan, so on a $300,000 loan, if you were paying a payment of $30,000 or more, you can pay a fee to the lender. I usually find it's about $400 to $600. I've seen it as high as $1,000, and that they will recast your mortgage payments without having to refinance, which is nice because then you get the benefit of that extra payment and you've lowered it. Now, if you don't do that, what's nice is you've actually changed the amortization. And so if you make a big payment on a loan and keep the payment where it's at, you're actually paying off the loan faster. All right, so hopefully that helps. I know it's a little tricky. You can always reach out to me direct no matter where you're at, kind of explain to me your situation, and I'll give you my thoughts on if you can drop the PMI and what you would need to do. So hopefully that helps. Again, like the video if you find it helpful. Reach out to me if there's anything I can do to help. Remember, I'm here in Central Florida, no lender fees, transparent, easy to understand mortgage advice that you can count on, and let me know what I can do to help. All right, I'll talk to you soon. Bye-bye.